Hi and welcome. My name is Greg Klein with Hayes Financial Group, and this is a recorded presentation of our Roth versus Pretax seminar. The agenda for the presentation is as follows. We will briefly discuss the similarities and differences, and dare I say how Roth in your employer plan is a little bit better than a Roth IRA. We'll explain in detail Roth in your employer plan, Roth in your 401k, 403b. We'll go over some examples to see how saving via Roth might impact you, and then finish up with some of the most frequently asked questions. I find that based on my experience, a lot of us have the same questions and pretty common concerns around Roth, so we'll get to some of those frequently asked questions, and you'll have my contact information at the end of the presentation, so if you have more questions, don't hesitate to reach out after you listen to this. First up, how Roth in your employer plan differs a bit from a Roth IRA, and we'll call out a couple of the biggest differences between the two Roth vehicles. All Roth options have similarities. First of all, their namesakes. If you've ever wondered why on earth do they call it Roth? Well, it is named after Senator Roth of Delaware that brought this first to the public and got it passed through law, and now gives us the option to save in this fashion in our retirement accounts. And so it is a retirement account funded with after-tax dollars, so you pay taxes now to avoid paying taxes later upon distribution. But Roth 401k, 403b accounts are different than Roth IRAs, and there are some key differences, and so we'll get into those on the next couple slides. One of the major differences between the two, so between Roth IRAs and Roth 401k, 403bs, is that you can contribute much more to a Roth employer retirement plan than you can to a Roth IRA. As you can see here, this year is 2020, so we'll look at 2020 contribution limits. And for Roth IRAs, again, that's a Roth individual retirement account that you would have on your own outside of your employer plan. In a Roth IRA, you're only allowed to contribute $6,000 if you're under 50, or up to $7,000 if you're 50 or older. Whereas in a Roth employer plan in 2020, you're allowed to contribute up to $19,500 if you're under 50. And if your plan allows for catch-up contributions, if you're 50 or older, you're able to save all the way up to $26,000 total in 2020. So the difference is significant there, the difference of thousands of extra dollars that you can save in Roth via your employer plan compared to a Roth IRA. The other major difference between the two Roth IRAs and Roth through your employer plan is there are no income limits on Roth through your employer plan. For example, you can see on the slide, if you're married and you file taxes together with your spouse, you cannot, I repeat, you cannot make a Roth IRA contribution in 2020 if you earn more than $206,000 combined between the two of you since you file your taxes together. However, because there's no income limit on Roth contributions in your employer-sponsored retirement plan, you can still make Roth contributions to your employer plan. So I repeat, no income limits or no income restrictions on who can participate in Roth via an employer plan. Whereas Roth IRAs, you are restricted. You might not be able to contribute up to the maximum, or you might not be able to contribute to a Roth IRA at all. But everyone, if you're eligible for your employer plan and it has Roth available to you, you can save via the Roth feature in your employer-sponsored plan. All of the advantages of Roth are shared by IRAs and Roth and employer plans. But the employer plan is a bit like Roth Plus because there are no income restrictions, and so you can save much more each year. Now that we've set that level, we understand the difference between a Roth IRA, Roth 401k, 403b. Now let's get more into the details of your Roth 401k, 403b. A couple of the basics. We already mentioned that all or part of your contributions to your employer plan, it matters how much you choose to save in the Roth, if you save all of your contributions via the Roth or just part of your contributions, but they will go in on an after-tax basis. So with Roth contributions, because you're paying taxes at the time you make the contribution, qualified distributions are free from federal tax. Keep in mind, these distributions, they will include any of the interest or growth that's accumulated on your account. So that's where the advantage of Roth is. You pay taxes up front, but a qualified distribution, you'd be able to take out everything that you put in that you already paid taxes on, and any of the growth or interest that you made on that money, and have that be completely tax-free. And as we already saw, a regular Roth IRA, it has some income restrictions, and your Roth 401k, 403b does not. And then the savings amount that you're able to put into a Roth 401k, 403b is actually higher. We will detail what a qualified distribution is, so don't worry, we'll get to that. But those are just kind of some of the basics so you understand what Roth is. Now we'll compare pre-tax and Roth side by side. We'll look at a couple of these key characteristics, the first one being contributions. Pre-tax is what people are used to. It might also be referred to just as 401k or traditional 401k contributions. Those are the variety that go in before tax, so they reduce your taxes now, and you pay your taxes later at distribution. So it's no taxes now, pay the taxes later, where Roth is an after-tax deposit, so you pay your taxes now in order to avoid paying taxes later. On distributions, which I just touched on, so I'll repeat that, the tax on pre-tax is paid at the time of distribution, where Roth qualified distributions are tax-free. 2020 maximum contribution amounts are going to be the same between pre-tax and Roth, $19,500, or up to a total of $26,000 if you're 50 or older with that catch-up amount. I'll touch on this too in the frequently asked questions, but so you understand that $19,500 maximum that you're able to contribute this year into a 401k, 403b, that is the total that you can save between both pre-tax and Roth. So let me be clear on that. It does not mean you can save $19,500 for pre-tax, $19,500 Roth. No, it's $19,500 total for you as an individual, but you choose how you want to split that up. If you want to do all pre-tax, all Roth, or a combination of both. Rollovers of pre-tax dollars, they can go to another pre-tax or traditional 401k or traditional pre-tax IRA. Rollovers of your Roth 401k, 403b dollars, those can go into another Roth employer plan or to a Roth IRA. So they're just separate. If you have both pre-tax and Roth dollars, when you go to distribute your account, if you want to move those into IRAs, they go into separate IRAs. Both can be held in one 401k, 403b. If you have IRAs, they're actually separate accounts. And then required minimum distributions, that's when you reach the young age of 72, when the IRS requires you to start taking money out of your pre-tax account. So that's required from both pre-tax and Roth, assuming the money is still in your employer plan. Now, the difference with RMDs, or those required minimum distributions, is if you take those Roth dollars from your employer plan and move them into a Roth IRA, because minimum distributions are not required from a Roth IRA. Since you've already paid taxes on those deposits, Uncle Sam does not require that you start to take that money out at 72 like he does with employer-sponsored plans or traditional IRAs. So if you are in a situation where you know you're not going to want to be forced to take this money out at 72, you might want to try to pass it on to your beneficiary or your heirs, then a Roth IRA is something that you want to look at. That's the one that allows you to avoid those required minimum distributions. Pre-tax and Roth, as you've seen, are sort of like inverses of each other. Contributions in the pre-tax account, again, they're not taxed now, whereas Roth, they are. Withdrawals from a pre-tax account, those would be taxed, whereas qualified withdrawals from a Roth account would not. So Roth and Pretax sort of work as inverses of each other. That's just how you can remember it. One is tax me now, the other is tax me later. Another way to look at Roth versus Pretax so that you can understand it better is think of your financial life journey and think of it as being a freeway or a toll road. And we start by looking at pre-tax, and with saving pre-tax dollars, you would start off on the freeway and you would cruise free until you get to retirement and begin withdrawals. And then essentially you hit the toll road. And so then with each withdrawal, you would pay a toll, that is income tax, on the amount you withdraw each year. Roth, on the other hand, would be like driving on a tollway now. And then when you're in your working years, you're paying these tolls or these taxes as you go on your deposits. And you don't get any tax break then up front. You're paying those tolls right now. But when you're going to get your tax break is when you're allowed to enjoy the open roads and ride free on that freeway in retirement. And you'd be able to take that money out tax free with those qualified distributions. So that brings up the two questions. How long is your road till you get to retirement? That's going to factor into Roth versus pre-tax. And then how high are the tolls that you pay? Are you in a high tax bracket paying high tolls now? Or are you going to pay less tolls later? Those are a couple of the variables that we'll look at in our examples. I said we would revisit the qualified distributions in this 5-year rule for Roth dollars. Qualified distributions of your Roth dollars, they take place at least 5 years after you made your first Roth deposit and after the important age of 59 and a half. This 5-year clock starts ticking from the first contribution that you make, regardless of when you make the contribution during that year. So for example, if you contribute before December 31st, 2020, you get the full year credit. So 2020 would be the first year that you made a Roth contribution for this 5-year rule. If you have to take a Roth distribution that is not qualified, then you'll have to pay taxes on a proportional amount of your earnings and may be subject to the 10% penalty tax. So you want to make sure Roth contributions, or excuse me, Roth distributions are qualified. If you have less than 5 years to go before you need this money, you may want to consider not investing in the Roth. And that's something that you can discuss with your tax advisor, but understand to take full advantage of the Roth with qualified distributions, you want that stopwatch to be running for 5 years since you made your very first Roth deposit. Well, let's say, okay, so however, if you separate from your employer, you can roll those dollars into a Roth IRA. Now, maybe this Roth IRA has a clock that's been running for a long time because that's got a separate 5-year clock. So if you have an existing Roth IRA, you could always move money into that account, and that it's going to start that clock from the very first contribution that you made to that Roth IRA, however many years ago that was. But if you do a rollover and you open a brand new Roth IRA, just remember, your clock is going to start over with that new Roth IRA. So that's something to also consider. But Roth IRAs, then the last point I'll make on that is they also do allow you to take out your contributions at any time without paying any taxes. And that's not the same for your Roth employer plan. Roth employer plans are more restrictive when it comes to contributions. So you always want to check into your employer plan and understand when you can even withdraw money from the employer plan. It's not as flexible as maybe you've heard or read about with the Roth IRAs, where Roth IRAs, you can basically tap into your contributions at any time, no harm, no foul, and not have to pay any taxes. So how would this work in your employer-sponsored plan if you have pre-tax, Roth, and possibly an employer match? Well, the idea that I want you to grasp here with this picture is that a 401k, 403b account, well, it's protecting your money from taxes. And as long as the money is underneath that umbrella, so as long as it's in your 401k, 403b, then it's protected from taxes, it's protected from creditors. But if you start saving via Roth, you're not opening up a new umbrella. You're not opening up a new account. You're just adding a bucket underneath that existing umbrella. You have one 401k or one 403b. The different buckets of money that you fill up underneath that umbrella is up to you. Maybe at this point, all you've done is put money into that pre-tax bucket. Maybe your employer matches and puts money into the match bucket. Maybe you want to add Roth and you want to start saving via the Roth in that Roth bucket. But that is just adding a new contribution source. So that's not opening up a brand new account. It's not as if you're going to have two separate accounts. You would just have a different source of monies in your 401k or 403b. So you choose how much, if you want to put money into that Roth bucket, how much you put into the pre-tax bucket. Then your employer, if your generous employer makes a matching contribution, that'll go into a separate bucket. But just important to understand that these monies, they'll be in these different buckets. They'll all be under one account or under one umbrella. But only the Roth dollars, if it's a qualified distribution, is what would come out without paying any taxes. So those other two buckets, like the pre-tax dollars, the employer matching dollars, those are buckets of money that will be taxed upon distribution. Roth is the only bucket where you add money to that, and whatever it grows to with interest and earnings, you get to pull those out tax-free. Then, just understand that, because if you do Roth from the very beginning with your account and all you ever save is Roth, but you do get an employer match, remember that you will have dollars that will be taxed then upon distribution. Even though all you ever did was Roth, any employer match is considered a pre-tax source, and that will be taxed upon distribution. How do you decide if making a Roth contribution is right for you? As a general rule, if you believe your tax rate will be lower when you take distributions or lower in retirement, then consider keeping the bulk of your contributions pre-tax. Also, if you want or need more take-home pay today, then look towards pre-tax. However, if you believe you'll be paying higher taxes or tax rates will go up in the future, consider making contributions to the Roth 401k or 403b. As we will see in a moment, if you have a long time horizon, meaning you're just starting your career, you're in your 20s or 30s, Roth may be much more attractive. Or if you are ineligible for a Roth IRA, you might want to take advantage and get some tax diversification with your retirement savings and contribute to the Roth through your 401k or 403b. Tax rates and your age or time horizon will be the two key factors in looking at this discussion of pre-tax versus Roth. This chart depicts a typical path, or we'll call it a rule of thumb, when we look at pre-tax and Roth. As someone is young and in a lower tax bracket typically, Roth can benefit them much more. So when they're lower down on the tax scale, so lower down in this chart in that purple section, farther to the left, younger in age oftentimes. But then as you age, hopefully you'll make more money. You might go up the tax brackets, and so you might climb into that black section where maybe you're doing a combination of both Roth and pre-tax. And as you get to the top into that blue section, you're in your highest income earning years, your time horizon is shrinking, you're getting closer to retirement. That makes Roth less attractive and makes you look more towards the pre-tax. So this is a rule of thumb, gives you an idea of how that progression typically happens. One other point I wanted to mention with Roth, it ties back to the fact that you can avoid minimum distributions, or the RMDs, with a Roth IRA. So Roth can be used more for estate planning if you aren't required by the government to deplete your account as you age in retirement like you are with pre-tax sources. If you know you're in that situation, that might be another reason you look to Roth, because you can use it more for estate planning when you get to retirement, those Roth dollars can be moved to a Roth IRA where they can sit and you're not required to take those minimum distributions each year. Let's illustrate some of these concepts we've been discussing up to this point with the following examples. First, how pre-tax and Roth impact your paycheck differently. We're going to assume gross pay of $2,000, and we're also going to assume a savings rate of 5%. You will notice right away that saving 5% of a gross paycheck of $2,000 means you're saving the same $100 in this case, whether it's pre-tax or Roth. It's going to be based on your gross pay, whatever you decide to contribute. So whether you do pre-tax or Roth, if it's 5%, it's going to be the same $100 no matter what. Where we're going to see the difference is with the taxable pay. So on the left-hand side, the pre-tax side with the blue paycheck, the taxable pay is just $1,900 because that $100 contribution is not taxed now. It will be taxed later. On the right-hand side with the orange paycheck, the full $2,000 gross pay is going to be taxed, so the taxable pay is the same, $2,000. Assuming a tax rate of 22%, you see how much tax would be paid, and the pre-tax side, the blue side, would pay a little bit less tax from each paycheck, so their net pay would be a little bit higher. So again, pre-tax is less taxes now, you're going to pay those taxes later. Roth, you pay a little bit more tax now, but later on at distribution, as long as it's a qualified distribution, then you would not have to pay those taxes down the road. What does this look like then when we project out? Assuming taxes are the same now as they will be in retirement, so we assume that 22% tax rate, we're in the same tax bracket today as we will be in retirement, and the same amount going into the accounts, both pre-tax and Roth, like we just saw in the previous slide, $100 going in, whether it's Roth or pre-tax. We project that out, we look at retirement, and we look at the after-tax retirement total. So after taxes are taken at retirement, what are you left with? And remember, Roth at retirement does not have to pay any taxes, where that pre-tax portion or retirement account total gets diminished because there are going to be taxes deducted from that in the future. So you might look at this and sort of question, wait, why, if we're saving $100, whether it's pre-tax or Roth, why are those charts on the right, why aren't they the same height? Why isn't pre-tax and Roth the same? Well, they would be the same, but then when you take those taxes away from the pre-tax monies in the account, that's what diminishes it and reduces it down. And so remember, saving $100 pre-tax and $100 Roth, it's not an apples to apples comparison because the pre-tax is going to be reduced eventually at retirement. So if taxes are the same now and in retirement, Roth would be more advantageous. If you know you can save $100 and you're deciding whether you want to do it pre-tax or Roth, well, if you can save $100 Roth, save $100 Roth because that's going to be better because in the future you won't have to pay taxes from that $100. But like I said, it's not really apples to apples. So let's make some changes and try to do more of an apples to apples comparison. If we return to our paychecks to do more of an accurate comparison, we need to look at the net pay. So the gross pay is the same, $2,000 for our two paychecks that we're looking at, but we want to end up with the same net pay of $1,460. And in order to do that, we'd have to up the pre-tax contribution percentage. So saving 5% still on the Roth side, but to end up with the same net pay, we would need to save around 6.4% on the pre-tax side, or up that to $128 a paycheck. You'll then see the taxable pay, the taxes that are deducted from each paycheck, and we end up with the same net pay. Because the pre-tax saver will have to be prepared to pay future taxes at retirement, those future tolls, like we saw and that your toll road is lying ahead if you're saving pre-tax, they would have to save a little bit more to plan ahead to cover those tolls in the future. So now we're on more of an apples to apples comparison, saving 6.4% or $128 pre-tax would be similar to saving 5% or $100 in Roth. Let's return to our example. Only now let's do apples to apples comparison and have the pre-tax only saver putting a little bit more away, or $128 from each paycheck. We still assume the tax rate is the same now as in retirement, and as we project out, drum roll please, we end up with equal amounts at retirement for your after-tax total. So now the Roth saver is saving a little bit less, but when they get to retirement, they don't have to pay all those taxes on their nest egg. The pre-tax saver would be saving a little bit more from each paycheck. Then when they get to retirement, they have a chunk come out for the taxes, and once they pay those taxes, then they're on equal footing as the Roth saver. But this is where so many people make a minor error that can have a major impact. Most savers will decide first the percentage that they're going to save. In this case, let's say the employer matches on 5%. So maybe this saver decided, I'm going to save 5% of my pay. After choosing that percentage, then they make the decision, I'm going to save that 5% either Roth or pre-tax. But as we've just seen, doing that can be a drastic error, because saving 5% pre-tax is not the same as saving 5% Roth. Because 5% pre-tax will get you to a decent nest egg at retirement, as we've seen. But on the previous slides, we saw that a chunk of that is going to come out in taxes. So to get on the same footing as a pre-tax only saver, you need to save a little bit more. We now have our Roth and pre-tax savers doing an apples to apples comparison, but we can tweak some of the other variables. I mentioned taxes is one of the important variables when you're comparing Roth to pre-tax. So now look at this chart and let's assume a lower tax rate today versus the tax rate in retirement. And if we project that out, we say, well, my taxes are lower today. I expect to pay more taxes in the future. Then Roth would benefit this person more. If we switch that around and we say a higher current tax rate compared to what your tax rate will be in the future, we project out and we see that in this case, pre-tax savings is better. Again, a higher tax rate now benefits pre-tax. Or on the previous slide, a lower tax rate today benefits Roth. So that's one of the key variables, taxes, tax bracket. Another is your age or your time horizon. So let's look at that next. We return to assuming that taxes will be the same today and in retirement in the future. We have our apples to apples comparison. So these people, Roth and pre-tax, two different people, they end up with the same net pay. So they're going to be on track to have the same retirement savings after tax. But if we look at a person that has a much longer time horizon, so previously we were looking at a middle-aged person, 40 years of age. Now let's look at a 25-year-old and we say taxes are the same, but we project out and look and we see that Roth would benefit that person much more by the time they get to retirement. Why is that? Because the younger saver has such a long runway that by the time they get to retirement, a lot of what they have in their 401k or 403b is going to be interest or earnings that they've made on their deposits. And remember, the interest or earnings out of a Roth deposit, they will come out tax-free in the future. So because of this long time horizon, this person has benefited much more, tens of thousands of dollars, by choosing Roth. Lastly, what if your runway is not as long? You don't have as long of a time horizon. In this case that you see on this slide, this person's 55 years of age. We see with this short time horizon, assuming that taxes are the same today as in retirement, it does not make a big difference between Roth and Pretax. So no major difference one way or the other, and that's why I stress if you're young, Roth can certainly benefit you more. You have that long runway. If you know your taxes will be higher or lower today or higher or lower in the future, that can provide you some clarity on which way to go with Roth versus Pretax. But if you assume taxes are the same today as they will be in the future, you don't have that long left to save. You can see projecting out Roth and Pretax, there's not really a clear winner. It's pretty much a wash. We will wrap up the presentation with some of those frequently asked questions around Roth. Why contribute to Pretax and not to a Roth account? Well, again, if you expect to pay lower taxes in retirement, Pretax can benefit you more. If you struggle to save enough to get your full employer match, Pretax might allow you to do that. Remember, Pretax savings gives you more in your take-home pay today, and it takes some of the pain out of saving money from your paycheck for your future retirement. So those might be some reasons why you want to look at Pretax. Why contribute then to a Roth? Well, pay your federal income tax now, be done with it so you don't have to pay it in retirement. And that does give you some more control over your retirement distributions and your tax situation. If you have that Roth bucket of money that you can draw from in the future, that allows you more flexibility, more control over your future tax situation. If the only buckets that you have under the umbrella of your 401k or 403b are pre-tax and employer match, then you have no choice. Anything that you pull out of those buckets will be taxed later on. Contributing to a Roth certainly can benefit you more, give you more retirement savings, but it can also offer you that diversification or that flexibility with your tax situation in future. How do you choose? And we did touch on this with one of our slides earlier, but you really don't have to. You can do both. Keep in mind that any employer match that you receive is a pre-tax source. So if you get matched, you're automatically getting pre-tax savings. You may want to do some of your own savings via Roth. And that diversifying, just like you diversify with your investments, that allows you that additional flexibility when you do get to retirement. Can you contribute up to the IRS limits in both pre-tax and Roth? And the answer to that one, sadly, is a big fat no. Your combined contributions, the total that you save as an individual in any 401k or 403b in 2020 cannot exceed $19,500 or up to $26,000 if you're 50 or older. And that's a total across the board between Roth and pre-tax. You're not allowed $19,500 in one and $19,500 in the other. It's $19,500 total for you as an individual, however you want to split that up. It does not count employer matching contributions, however, but $19,500 is the limit for you as an individual for both Roth and pre-tax total. If you contribute to the Roth account in your employer's plan, and you still have your Roth IRA on the side, and of course, assuming that you qualify under the income restrictions, you can still have a Roth IRA on the side, even if you contribute to the Roth through your employer-sponsored 401k, 403b. If you contribute to the Roth and your employer matches, will the employer match go into a Roth source, or will you receive that employer match? And of course, you still receive your employer match, but remember that goes into that separate employer match bucket, and that bucket of money is treated as a pre-tax source upon withdrawal. So yes, you'll still get matched, but no, employer matching contributions are not considered Roth. If you do Roth contributions and all you do is Roth contributions, you'll still get employer match, but the employer match will be considered pre-tax dollars. Rolling a Roth IRA into a Roth 401k or 403b, unfortunately the IRS does not permit rollovers in that direction. However, you can choose to roll your Roth 401k, 403b dollars into a Roth IRA after retirement or separation from service. Back to minimum distributions, are they required from Roth 401k, 403b accounts? And they are, but they are not from Roth individual retirement accounts or from Roth IRAs. So if you leave those Roth dollars in your employer plan, once you get to age 72 and are required to make those minimum distributions, they will look at your entire 401k, 403b account. If you do not want to take those minimum distributions, you can always move your Roth dollars to a Roth IRA, and then you do not have to take those minimum distributions. Rolling to a Roth IRA, do you need to wait the 5 years, have that 5-year clock run before you can take a qualified distribution? And you do. A new 5-year clock begins if it's a new IRA that you roll into. But if you have an existing Roth IRA, remember the clock started whenever you made the first deposit to that IRA. So you're not going to reset that 5-year clock by rolling money into that IRA. Just remember, the clock always starts when you make your first Roth contribution, either to your employer plan or to that IRA. If you're saving via the Roth, investment choices will be the same. There's no difference for the money that you save, pre-tax or Roth or your employer match. The investment lineup, the choices that you have as far as investments will be the same for all of those sources of money in your retirement account. Last frequently asked question is, since Roth contributions are made after tax, can you withdraw that Roth money from your employer-sponsored 401k, 403b at any time? And the answer is no. And this is, again, different from a Roth IRA, where you can always withdraw your contributions at any time. But remember, dollars in an employer plan like a 401k, 403b are still restricted under the rules of your employer-sponsored plan. Just because it's Roth, don't confuse that rule with the Roth IRA. You are not going to be able to just take that money out at any time because you've paid taxes on it. It's still subject to the rules of the plan. Takeaways for you then: Roth is taxed now. Qualified distributions are tax-free. So if you want to pay your taxes now and be done with it, look to the Roth. If you have a long time horizon, meaning if you're in your 20s, early 30s, you certainly will want to pay attention to the Roth if that's available to you. If you know for sure your taxes are going to be lower in the future, then pre-tax might still benefit you more than Roth. If you are certain that you're in a lower tax bracket today than you will be in the future, then that, again, is Roth. That's those two variables, time horizon and tax situation. They can help you with making that decision between pre-tax and Roth. And then if you switch from Roth to pre-tax, just remember, pre-tax savers need to save a little bit more. You need to have a bigger nest egg because a chunk of that nest egg is going to go to taxes in the future. So pre-tax savers, you want to have a little bit higher percentage compared to Roth-only savers. Thank you for listening to this presentation. I appreciate your time. My name again is Greg Klein. My email and phone number is listed on this slide, so if you have other questions that I didn't address, please reach out to me and we'll talk to you at future webinars. And take care. Be well.